Good morning and welcome. This is part of the Audit, Control, Governance, Risk and Compliance Series 1. As part of this series, we will be covering 11 areas. The details are as shown. Good morning. This is part of the Audit, Control, Governance, Risk and Compliance series. This specific session would be focusing on the risk aspect of GRC. We will be looking at case studies to ensure that we have our perspective cleared so that as we move further, we understand the full context when we manage risk or when we are doing audit or when we are having governance related engagements. Best wishes. Risk management is a critical function within any organization, ensuring the identification, assessment, and mitigation of risk that could impact operations, finance, compliance, and reputation. A robust risk management framework provides a structured approach to managing uncertainties, enabling organizations to anticipate potential threats and take proactive measures to mitigate them. Without a risk management framework, businesses would expose themselves to operational inefficiencies, financial instability, regulatory violations, and reputational damage. This series explores the importance and benefits of having a strong risk management framework, and we will also look at the disadvantages of not implementing one. Welcome board. Before we go into the definition and the theory part of it, it is better to understand some case studies. This helps us to understand the context of what we are going to learn or understand as we move forward. To understand the concept of risk, let us look at some case studies. The first case that we have here is a case where there was poor risk identification, the internal controls were ineffective. Because of this, there was a loss of $6.2 billion. This case is famously known as the London Whale scandal of 2012. The action resulting out of this is there was a requirement to strengthen the risk governance. There was a role created which is now known as the Chief Risk Officer's role. The risk reporting was revamped. The conclusion of this is proactive risk identification and stronger governance could have prevented the large financial and reputational damage which occurred in this case. The second case is due to cybersecurity vulnerability causing massive data breach, exposed about 40 million credit and debit card. This is a case of 2013. The action that was required to be done here was to implement a robust cybersecurity infrastructure and the vendor risk assessment. This is one piece which has evolved over the last decade. Now it's one of the critical functions of risk management, a separate specialized field, a career path which any risk manager or an auditor can look at and the management need to be aware of. And this is part of a critical item on the table. The conclusion was to have an effective risk assessment and vendor management. This which could have mitigated the breach and prevented the loss of trust which occurred because of this. The next case is from Boeing, known as the 737 MAX crisis. This is a case where there were inadequate risk communication and safety assessment. The resultant of this, they have to overhaul the safety practices. regulatory and compliance procedures. The conclusion was anticipating technical risk and maintaining transparent safety review could have avoided the fatal consequences. The consequences in this case were two crashes due to MCAS software failure, something which could have been avoided. The next case is wherein the governance and the compliance gaps were identified. This is a case from Infosys. The context is the whistleblower complained about accounting irregularities. The resultant of the review was that the board was strengthened for oversight and the whistleblower protection program was initiated or enhanced. The conclusion: transparent governance and internal control protects reputation and investor confidence. Whistleblower protection program is now one of the cornerstones of governance, seen in every reputed organization, and any new organization setting up the governance framework has this in their list. The next case is wherein there was a disruption due to natural disaster and it exposed the supply chain dependency. The resultant of the review was identified to create diversified and regionalized supply chain. This comes from the experience of 2011 Japan earthquake, which disrupted the part supply, affecting the organization, in this case Toyota. Their complete supply chain had a disruption, a serious disruption. The learning is, in conclusion, that anticipating operational risk leads to supply chain resilience and business continuity. The next case is wherein known security vulnerabilities were left unpatched, causing breach wherein 147 million people data was exposed. This is the case of 2017. The organization here is Equifax. The result of this review, there was an appointment of CISO, there was a revamp of the cybersecurity strategy, and a regular audit was triggered as part of their overall governance. In conclusion, regular risk assessment and timely mitigation are critical to prevent regulatory and reputational fallout. The next case is wherein operational safety and compliance were ignored or not looked at. The impact of this gap was the oil rig had an explosion, causing massive environmental and financial damage. This is a case of 2010, and the organization in here is BP. The incident is known as a Deepwater Horizon oil spill. The result of this review and the action was to enhance the risk control. Environmental and safety protocols need to be revisited, and new controls had to be enabled. In conclusion, ignoring operational safety risk can lead to catastrophic financial and reputational losses. The next case is wherein regulatory and ethical non-compliances were identified. The resultant action was they had to pay multi-billion-dollar fines, needed to restructure the complete compliance team. In conclusion, strong ethics and compliance framework prevents legal risk and reputational damage. Next case is related to logistics, wherein during the COVID-19 disruption, Amazon as an organization had external disruptions which strained its operation and its logistics. The action arising out of the review is agile risk mitigation with investment in infrastructure and employee safety brought out. In conclusion, managing uncertainty through agility sustains operation and customer satisfaction during crisis. The last case is related to technology and reputational gap, wherein autopilot accidents raised concerns about the product safety, impacting the reputation of the organization, in this case Tesla. The resultant of the review was that enhanced AI safety features, proactive media engagement need to be done. In conclusion, from this experience or this case study is anticipating product risk and transparent communication protects the reputation and builds trust. A critical learning from this incident for many organizations, either in this field or any other field. Now, with the context of case studies behind us, we do have a perspective about how things work when we have a risk management framework in place and what happens when we don't. In summary, let's go through some key points on the importance of risk management in an organization. A risk management framework is essential for organization to navigate uncertainties and protect their interest. A well-defined risk management framework helps organization anticipate and prepare for potential threat, enable businesses to recover quickly from disruption, ensuring continuity of operation. This is from enhancing the organization resiliency perspective. Risk management framework helps identify financial risk such as market volatility, currency fluctuation, and credit defaults. It prevents financial losses by implementing strategies such as hedging, diversification, and contingency planning. Many industries are subjected to strict regulatory requirements that mandate effective risk management practices. A structured risk management framework ensures compliance with legal, financial, and industry specific regulation, avoiding fines and penalties. A proactive risk management approach helps prevent crises that could damage an organization's reputation, demonstrates accountability and responsibilities, fostering trust among investors, customers, and partners. Risk management framework provides data driven insight that helps management assess potential risk and opportunities. It encourages strategic decision making by weighing risk factors and elevating their potential impact. It also help identify inefficiency and vulnerability in business processes, streamline workflows, and implement best practices to reduce risk associated with operational failure. The risk management framework addresses risk related to cyber threats, data breaches, and IT system failures, implements robust security measures to protect sensitive data and business assets. The risk management framework encourages employee at all levels to be proactive in identifying and managing risk, also reducing the likelihood of internal fraud, errors, and compliance breaches. Let's now review some benefits of good risk management framework in an organization. Implementing a strong risk management framework offers several advantages that contributes to long-term organizational success. Some of these benefits include early risk identification and prevention. In this, a structured framework enables organization to detect risk before they escalate into major issues. Preventive measures can be implemented to minimize potential damage. From cost reduction and financial protection perspective, this reduces costs associated with legal dispute, operational failures, and financial mismanagement. It protects cash flow and profitability by mitigating the financial risk. Organizations with strong risk management framework are more resilient and adaptable to market changes. They can seize opportunity with greater confidence, positioning themselves ahead of competitors. A risk management framework includes contingency plan for handling crisis effectively. It ensures that essential business functions continue during disruption such as natural disasters, attack, or economic downturn. From a resource allocation perspective, it helps organizations prioritize resources based on risk exposure and potential impact. It ensures efficient use of manpower, technology, and financial resources. From an investor or stakeholder confidence perspective, the investor, regulator, and customer have greater confidence in organizations with transparent risk management practices. They build long term relationship with stakeholders by demonstrating a commitment to stability and security. From a corporate governance perspective, risk management framework aligns with corporate governance principle, ensuring ethical decision making and accountability. It encourages transparency in reporting and compliance with industry standards. From adaptability to regulatory and market change perspective, organization with risk management framework can quickly adapt to changes in regulatory requirement and market conditions. It ensures long-term sustainability by staying ahead of emerging risk. Let us now review some of the disadvantages of not having a risk management framework. Organizations that fail to implement risk management framework face numerous challenges and risks that can hinder their growth and their sustainability. Some of the disadvantages are increased exposure to financial losses, wherein without a risk management framework, organizations are more susceptible to financial risks such as fraud, market fluctuation, and economic downturns. Their lack of preparedness can lead to substantial financial setback. Failure to comply with industry regulation can result in fines, penalties, and legal actions. Non-compliance can lead to business disruption and reputational damage. Lack of structured risk management approach results in unstructured workflow and inefficiencies. This increases the likelihood of project failures, supply chain disruption, and production delay. Poor risk management can lead to scandals, lawsuits, and data breaches that can damage an organization's reputation. Customer, investors, and business partner may lose trust in the organization, leading to loss of business opportunities. Organizations without risk management framework often make uninformed decisions based on incomplete or inaccurate data. This increases the likelihood of business failures due to miscalculated risk. Organizations with weak risk management practice may face higher insurance premium due to the increased exposure to risk. Unexpected expenses arise from dealing with crises reactively instead of proactively preempting them. Without a risk management framework, organizations are more vulnerable to cyber attack and data breaches. Security lapses can result in financial losses, regulatory fines, and reputational damage. Organizations without risk management framework struggle to respond effectively to crisis. Disruptions such as natural disasters, pandemic, or cyber attack can halt operation and lead to financial ruin. For those interested, here are few of the risk management framework that can be referred to. There are quite a few. Look at the key purpose behind each framework. You can pick up one, few, or you can pick up best of from each when designing your own organization's risk management framework. You can use as it is, you can customize it, you can have a building block made from each of them, and you can have your own, taking the inspiration from any of these or all of these. So best wishes from that perspective. Hence, in conclusion, a well-structured risk management framework is essential for organizations to identify, assess, and mitigate risk effectively. It enhances financial stability, regulatory compliance, operational efficiency, and stakeholder confidence. By implementing a risk management framework, organization can proactively address uncertainties and protect their assets, reputation, and long-term sustainability. On the other hand, failing to establish a risk management framework exposes organization to financial losses, regulatory penalties, operational inefficiencies, and reputational damage. Without structured risk management, business operates in uncertainty, making them vulnerable to crises that could lead to failure. To thrive in today's complex business environment, organizations must prioritize risk management as a fundamental component of their corporate strategy. A proactive approach to risk mitigation not only safeguards the organization but also position it for sustainable growth and long-term success. So in conclusion, for this series of audit, control, governance, risk and compliance, we have covered 5 topics at this point of time. We have covered introduction, the history of banking, regulators in banking, governance and risk. We have 6 more chapters in this series. So thank you very much. Have a great day. See you in the next chapter.